Welcome to the deep dive. We take these big, complex industry challenges and, well, we try to distill the actual blueprint for change.
Mhm.
If you've been watching the financial sector and wondered why, despite some record profits lately, the efficiency of these huge global banks seems kind of stalled, you are about to get the definitive answer. Today, we are diving deep into banking productivity.
Mm.
And the stakes, they couldn't be higher. We're talking macroeconomic, geopolitical uncertainty. It all means banks really must hit returns on equity, ROE, of 10% or more, and returns on assets, ROA, of 1.5% or higher. But the system, it's struggling to keep up. So we're here to detail the strategy for sustainable, lasting improvement.
Yeah, and I think the first thing we have to understand is why those older, simpler cost-cutting drives, why they failed. Typically, those efforts, they gave maybe short-lived gains, 3 to 5%, maybe 10% max, but then the cost just crept back up because they were only treating symptoms. The real problem, the thing really anchoring productivity down, is this complexity creep.
Complexity creep. Okay.
And we have a truly, well, astonishing metric that really highlights this. Just look at the cost of originating a single mortgage. It has risen 8% annually over the last decade. Think about that. It jumped from roughly $5,100 back in 2012 to a staggering $11,600 in 2023.
Wow, that's more than double.
More than double. And the data is clear. This rise isn't just inflation. It's driven almost entirely by increasing workload, especially around risk and regulatory compliance.
That statistic really is the smoking gun, isn't it? If the cost for the exact same piece of work doubled, then yeah, complexity is the core disease, just like you said.
Exactly. So our mission today is really to move past those temporary fixes. We need to understand the challenges, the real ones hindering deep productivity, and then detail this necessary shift toward what the data calls simplification at scale.
Okay, let's jump right into that productivity puzzle then. Why are U.S. banks overall seeing productivity actually fall 0.3% a year since 2010? That completely bucks the trend we see in most other sectors, right?
It does. And the data points to this massive operational challenge that's been, frankly, completely masked recently.
Masks. How so?
Well, it's been masked by rising interest rates. High rates have really cushioned their earnings, you see,
Right.
creating this illusion of strong performance. But, if rates normalize, maybe come down, that cushion just vanishes. And suddenly, the underlying inefficiency becomes this massive drag on those ROA and ROE targets we talked about.
Right. And that structural failure gets amplified by all the increasing regulatory stuff.
Precisely. We know compliance is expensive.
Yeah.
It is. Heightened risk management requirements, increased regulatory compliance, it all means operational costs have climbed significantly. We're talking the last decade and a half. And it's not slowing down. Our research project's risk and compliance budgets, they're set to grow 5% a year through 2028. Though, I should add, any softening in U.S. regulatory policy could temper that specific spending trend a bit.
Okay, but here's where I have to push back a little, or at least ask. Banks are constantly talking about modernization, the cloud, AI. I mean, they're spending so much on technology. Why isn't that solving the productivity problem?
That's the real dilemma, isn't it? Global tech spending in banking has actually gone up 9% a year on average, but revenue growth, only 4%.
So they're spending way more on tech than they're getting back in revenue growth.
Exactly. They're spending the money without getting commensurate returns. Now, some of that spend is necessary, sure, data infrastructure for Gen AI, cloud migration, that's important. But here's the kicker. Financial services companies are simultaneously spending less on actual AI adoption than sectors like healthcare or tech itself or media and telecom.
So if the tech ROI is suffering, it really suggests the problem isn't just how they spend, but maybe the underlying deeply inefficient structure they're layering that tech onto. That brings us to that great metaphor the sources use. Improving productivity is like climbing a mountain where the slope suddenly gets really steep.
That's a good way to put it.
The near-term fixes, optimizing procurement, whatever, that's the gentle slope. But the core issues, that requires this multi-domain approach you mentioned.
Yes. And if we connect this to the bigger picture, it suggests banks are kind of perpetually treating symptoms. They're not curing the underlying disease, which is this operational complexity. They need a structural shift, something that addresses everything from the products they offer right down to the decisions made in support functions like HR or IT.
Okay, so how do they cure it? The sources point to this idea, simplification at scale. Is that the key?
That's presented as the key to lasting change, yes. It's described as an integrative approach. It tackles productivity, yes, but simultaneously with improving the experience for both clients and employees.
Right, not just cutting costs in isolation.
Exactly. The central idea, the kernel of the strategy, is rethinking the operating model to drive down the unit cost of delivery. Every single process has to be viewed through an ROI mindset. What output are we actually getting per unit of work? And this means getting pretty ruthless about complexity. A crucial component, and maybe a tough one, is reducing or even eliminating customer demand that generates very little profit or just adds unnecessary operational knots.
Yeah, that is a tough conversation for any executive, isn't it? Saying no to certain maybe low-margin activities or overly complex client requests, but the potential payoff sounds transformative.
It really is. The analysis suggests banks that adopt this comprehensive approach, this simplification at scale, they can achieve lasting productivity gains maybe up to 15% in 2 years. And that translates directly into an ROE increase of 1.0 to 1.5 percentage points. That kind of shift, that's the difference between hitting those crucial performance targets and falling short.
Okay, that sets the stage perfectly for what the sources call Pillar 1, simplification. Basically, applying Occam's razor to the bank. We're talking ruthless streamlining. And the most visible way we see banks doing this is by, well, scrutinizing their own business like an investor would, selling off non-core assets.
Right, portfolio simplification.
Exactly. Take Citigroup, for example. They really streamlined their retail banking portfolio, sold or wound down operations in 10 countries, including big ones like China and India. Their goal wasn't just cutting costs, right? It was focus, reallocating resources to more lucrative areas like wealth management.
And it seems to have paid off. They saw a 20% revenue bump in wealth management in 2024.
Yeah, that's significant.
And HSBC is doing something similar, selling consumer businesses in Canada, France, the US, really refocusing their energy on core high-return regions like the UK and Hong Kong, and also on serving wealthier clients. This kind of strategic pullback is simplification just at the highest portfolio level.
Okay, that makes sense. But the real payoff, maybe the real aha moment for anyone listening who works in a big corporation, that comes when we look at fixing the internal dysfunction, doesn't it?
Absolutely. This is critical. The research highlights a frankly shocking internal challenge. It's based on analysis of employee calendars, mid-level managers, and the like. They found that 60 to 70%, 60 to 70 of employee time was spent on internal discussions and updates, internal meetings, basically.
60 to 70%. Wow.
While only 30 to 40% was spent on actual client-facing work or things directly linked to producing an output, compared to, say, tech companies where it might be 80% plus client-facing. It's a stark difference.
So 60 to 70% of your week in internal meetings. I mean, that is the definition of an inefficiency tax right there. If that's the reality, how does simplification at scale tackle that internal time drain?
Well, it has to start with decision-making. That huge amount of meeting time. It's often compounded by an overinflated ratio of, let's call them doers to overseers.
Doers to overseers.
Yeah. We've observed ratios in banks often running 1 to 2, 1 to 3, sometimes even 1 to 4.
So for every one person doing the work,
you might have 2, 3, or 4 people involved in overseeing, approving, checking, getting updates.
Wow. Okay, explain the consequence of that kind of ratio for us.
Well, it means for every single person actually completing the output, processing a loan application, writing code, servicing a client, you have multiple layers adding friction. Signatories, gatekeepers, people needing status updates, approvals, sign-offs, and all of that requires meetings, which requires more staff time, which increases overhead, which further drags down productivity. It's a vicious cycle.
Okay, so tackling that ratio is key. Beyond headcount and meetings, what other simplification themes are critical here?
Another big one is adopting a clean sheet approach, especially for support functions.
Yeah.
Think finance, IT, legal. This means basically ignoring the messy legacy processes that exist today and designing the function from scratch, based only on the essential required outcome. For instance, maybe creating common data standards across risk reports and financial reports. That instantly cuts complexity rather than trying to optimize two different complicated reporting paths that grew up over time. We also see things like physical footprint reductions. Some banks have cut their branch numbers by 30% or even more, then reinvesting those savings into their digital channels.
Okay, that makes a lot of sense. And it sets us up perfectly for Pillar 2, scale and this idea of a marginal gains mentality. So once you've simplified, how do you achieve sustainable scale? The sources use this great analogy from British cycling.
Yes, the aggregation of marginal gains, championed by Dave Brailsford. It's a fantastic concept for complex systems. It's all about breaking down absolutely everything you do into tiny component pieces, and then trying to improve each little component by just 1%. whether it's, the cleanliness of the hotel rooms for the cyclists, or the ergonomics of the bike seat, or the nutrition plan, improve everything just a tiny bit. And the idea is that the compounding effect of all those tiny 1% improvements creates an outsized, significant overall result.
It's a powerful analogy, but applying that kind of hyper-granular focus to a, trillion-dollar global bank,
Yeah.
what's the toughest part there?
I think the difficulty is often psychological and cultural. It requires senior leadership to genuinely question every single inefficient unit quantity of work. What's the real cost of onboarding one client? How long does it really take to issue a standard loan? How many approvals are truly needed for a simple wire transfer? They have to be willing to chip away at those processes relentlessly, making marginal gains everywhere and ensuring that, say, the 1% improvement in tech testing actually combines with the 1% improvement in regulatory reporting and so on. It needs to be systemic.
And this is where technology maybe finally starts to really pay off. How does something like Gen AI enable this kind of scale?
Right, Gen AI can be the amplifier here. When it's implemented at scale across these newly streamlined processes, it can boost productivity dramatically. We saw one bank in the research achieve up to 30% productivity gains and a 20% improvement in customer experience using targeted AI tools.
30% productivity gain, that's huge. What kind of applications are we talking about?
Specific things like optimizing call center operations, helping agents find answers faster, maybe summarizing calls, assisting with writing credit memos, managing fraud and dispute cases more efficiently, and even accelerating tech development and testing cycles themselves.
Okay, but to leverage that Gen AI successfully, the tech function itself has to stop being a bottleneck, right? It needs to be efficient too.
Absolutely. The technology function is notoriously difficult to simplify, often plagued by these massive multi-year projects and, frankly, cost overruns. But by adopting really tight project scoping, truly integrating agile methodologies across the board, and ensuring strong business integration, making sure tech is built of what the business actually needs, not just cool tech that can achieve significant gains. We're talking maybe a 15 to 20% improvement in productivity for the tech function itself. And then when you factor in the potential for pure automation, the math comes undeniable. The data suggests 70 to 80% of standard calls and maybe 60 to 70% of customer or merchant disputes can be handled by automated systems without any human interaction.
Okay, so simplify internally, then scale externally using tech and marginal gains. Now, what's the ultimate outcome for the person on the street, the customer? It has to be a better experience, right? Because that operational complexity we talked about, it seems to have created a major gap in customer centrality. There is a survey mentioned, banks lagged 20 to 30% behind non-banks in just overall satisfaction with getting a mortgage.
Yes, and this is where all that internal work truly pays off for the outside world. If employees aren't spending 60 or 70% of their time in those internal meetings, guess what? That time can be refocused on the customer. It enables banks to actually design their operations around genuine customer needs instead of, forcing customers to navigate their cumbersome internal processes.
So what does that excellent experience actually look like in practice?
Well, the research points to three key shifts. First, as you said, true customer centrality, designing from the customer's perspective out. Second, providing a truly seamless omni-channel experience. Customers expect 247 access now, and they want to move smoothly between the app, maybe a branch visit, a call center, without having to repeat their story or start the whole process over again each time.
Yeah, that's incredibly frustrating when that happens.
It is. And we have seen banks achieve double-digit increases in customer experience scores and sales growth simply by getting that channel integration right.
Okay, centrality, omni-channel.
Uh,
What's the third piece?
Trust and personalization. Trust means clear, transparent communications, especially around things like fees. No surprises. And personalization means using analytics smartly. Not just to bombard people with generic product pushes, but to tailor relevant offers based on major life events, like buying a house or having a child, making the bank feel actually relevant to the customer's current reality.
That makes sense. Relevant, not just transactional.
Exactly. But I do need to add a crucial warning here. This simplification at scale idea, it's not some magic bullet, not a plug-and-play solution you just install. It absolutely must be strategically tailored to the specific context and goals of each individual bank. Are they preparing for a major M&A deal? Are they doing a full enterprise-wide refresh? The approach needs to fit the strategic objective.
Right, context is everything. Okay, so let's try and synthesize this. What does this all mean? We've learned that the banking sector's productivity stall isn't superficial, It's due to this deep-seated operational complexity, which for a while was conveniently masked by high interest rates. But the blueprint for lasting change seems clear. First, apply ruthless simplification. Fix the operating model, divest non-core stuff, cut that internal
Get
friction.
rid of the waste, essentially.
Yeah. And then leverage technology like Gen AI and automation combined with that marginal gains mindset to achieve sustainable scale.
Precisely. It's that combination of simplification and scale that creates the compounding effect. And frankly, that seems to be the only way for these massive, complex systems, which is what banks are, to sustainably reinvent themselves and actually hit those aggressive performance targets like 1.5% ROA. Without that twin approach, the analysis is pretty clear. Costs will inevitably just creep back up, and they'll be right back where they started, dragging down ROE and ROA again.
A powerful conclusion. We started with that mind-boggling stat. 60 to 70% of internal employee time spent on discussions, not direct output. So here is a final provocative thought for you, our listener, to maybe chew on. Consider how much of your own daily unit of work, whatever your job is spent on necessary output-linked activity versus those internal updates, meetings, and coordination. And then think about that 1% gain. What small marginal improvement could you implement, maybe even starting today, that could cumulatively push your team or your company just that little bit closer to its own vital performance targets? Something to think about.